that you things are classified properly. Some of the common areas where we see issues are on entertaining, for example. So clients entertaining is not allowable for tax purposes, but staff entertaining is. Often it's all lumped together, and sometimes you're missing then tax deductions on the staff entertaining element. I appreciate that, of course, there are consequences often for PAYE and benefit in kind consequences for staff entertaining. However, there is still a corporation tax relief that you can be claiming on that type of expenditure. And then just go back to the top of the slide there, other sort of more specific types of reliefs. R&D tax credits, AIA and an investment allowance and capital allowances. So R&D tax credits has had a lot of press in the press coverage in the last few years. And I think, if I'm being cynical, I think the government have done a good job in trying to almost scare people out of considering a claim for R&D tax credits. We do think it's actually a very valuable claim, and there are, I think, the most recent studies, I think, show that there's still businesses out there underclaiming their R&D tax credits or not considering them at all. And this is an area we do cover, so we always invite people to come and speak to us, because having that initial conversation might turn into a valid claim. And we've got very good experience in dealing with HMRC and making claims on behalf of clients for a number of years now. So we'd always invite people to come and get in contact. So the annual investment allowance, capital allowances, essentially that's when you expend on plants and machinery in general, as well as when you do office fit outs. Basically, you can get tax relief where for accounting purposes, those items be capitalized, so you wouldn't get relief against your profits for accounting purposes. So always important to approach an accountant to have a look at any capital expenditures taken place in the year to see whether actually there's some tax relief that can be claimed on those items. And then in terms of the middle point, business structure, again, question that comes up quite often with our clients. So you do still have people nowadays, it's quite common to start off as a sole trader or as a partnership, an unincorporated business, which has its own tax consequences. So essentially the profits that you make in an unincorporated business and most LLPs, they're taxable on the individuals. The profits are taxable on the individuals as they arise. And often the traditional journey is that when the business gets a bit larger, people start considering a limited company. And then that gives you a bit more flexibility as to the income that you need from the business, and has its own tax consequences. And again, we have a number of clients who we give advice about when they have got a limited company, how to take their money out of the business, because obviously there are different tax consequences as to whether you take dividends or salary. So we deal with the clients on the full life cycle of a business. Goes on to my next point on the slide here. So talking about salary versus dividends in very high level terms, a salary of course attracts national insurance above certain limits for employers and employees. But on the other hand, it does give you a credit for state pension purposes, a qualifying year for state pension purposes. So sometimes people do miss the benefit, the non-direct sort of tax benefits of taking a salary. Dividends, often, again, the traditional approach has been to take a small salary and then top up with dividends. There's been a number of tax changes, even from the last government and into this one, where the gap has narrowed a lot between taking salary and dividends. However, there's still a slight differential there where, at the lower end, up to sort of £100,000, you still want to do salary dividend mix. But the tax savings are less than they were before. And coming on to the next point about tax planning, outdated tax planning, I touched on it just there, where the tax reliefs are constantly changing. If I cast my mind back in the last 5 years, and even further back than that, there's been some quite fundamental changes in the Finance Acts and that chancellors have announced that might mean that what you're currently doing in your business needs a review. And again, this is the type of work that we can carry out for you to have a look at. Is for example, your business structure correct? Is it really achieving the most that it can in terms of tax efficiency? So we always welcome people asking questions on that. And then comes on to the next point about lack of specialist advice. We're strongly an owner-managed business firm. That's our client base. And actually then by definition, we are cross-sector. We have clients in recruitment, we have clients in heavy machinery, in tech, in consultancy. So a whole number of sectors we cover, and we've seen pretty much everything by definition. So we understand what considerations these business owners have in order to grow their business and develop their business. So we can always give you advice on those areas. And yeah, a health check is always useful because sometimes you get focused on running your business, and this is what we find with some of our clients. You get focused on running your business that you don't necessarily consider the strategic point of actually what are we looking to do and how should we be gearing up in order to, for example, make an expansion. And again, we can help you with that. So if I now go on to the part of the presentation that talks about tax efficiency, very more specific topics. EMIs, or enterprise management incentives. These are a discretionary employee share scheme. They're very popular because of the tax benefits they bring. So essentially, if you're an owner of a business, there's a few ways you can incentivize your staff. Obviously, salary bonus is one of them, benefits in kind is another. And EMI, or any other short share scheme, is another way. And what it does is it allows you to give to whoever you wish in your employees a stake in the business, or actually more accurately, a promise of a stake in the business, because an EMI is a share option. And one of the beauties of it is it's very, very flexible. You can design the EMI offering in any number of ways. So, for example, you can make them exit only, so that essentially the individuals, the employees that you award the shares to, only receive the shares when there's an exit. For example, you can design it that way, or you can give them other performance criteria. In terms of the tax benefits, what's good about it is, aside from the sort of upfront setup professional fees, costs, there isn't a huge amount else for the business owner to worry about, because all you're doing is you're setting up this scheme, and it's in tying people in without actually having to give them the shares. So in that sense, it's quite easy to get off the ground. There doesn't have to be a long time frame to implement one of these share option schemes. And in terms of the tax benefits, what it allows you to do is it's essentially like a deferred benefit is a good way to think about it. So it's a promise to give someone shares at a later date. And you can then, at the time of the award, you normally would agree with HMRC the valuation of those shares, and then the award would fall into place based on that valuation. And what it means is, very attractive for certainly startups where, in the first year or two, profits may be modest, or even you might be a loss-making business. And so when you agree the valuation with HMRC, it'll be a low amount. And then, if it was going to be exit only, for example, it might be many, many multiples higher than the share valuation might be many multiples higher than when you originally awarded the options. And so what you've given then to this individual is a disposal at a later date where they'll get capital gains tax with very low base cost. And one of the other advantages of EMI share options is you can get business asset disposal relief at the currently 14% rate. So whereas, if you were to give shares directly, you'd have to have 5% of the shares. With EMIs, there is no percentage requirement. And equally, there's also no requirement on the type of shares for EMIs. So basically, if you've got a trading company, most trades are eligible. There are some exclusions, but if you've got a trading company, it's normally the first thing we would advise someone to think about if they were thinking about, these key staff members that they want to incentivize. And on the other side, there are benefits actually for the business owner. Whilst you are giving up obviously some of the stake of the business, what you're doing is also enabling the company to get corporation tax relief, essentially, when there's an exercise. So it does benefit the founders as well, indirectly, because there's going to be a big tax saving if there's a successful sale down the line. Now moving on to, I suppose, a more external tax relief. So the EIS Enterprise Investment Scheme and Seed EIS, which is for newer companies. They're both tax reliefs for investors. So you might have businesses that can claim or are eligible for EMI, which is sort of employee share scheme incentives, and might also want to raise funds externally from investors, and they might use EIS as well. Two separate things, but actually some of the qualifying criteria overlap. And again, with our client-based owner-managed businesses, we often have people who are seeking outside investment. They often have people in their networks they know they can raise money from. And if you can fit the business, and if the business qualifies, so as you can see there's certain trades that don't qualify, like property investment, accountancy, legal services, some financial services. So outside of those most common exclusions, most other trading companies will qualify if they're of a certain size, smaller size, SME sector. And the benefit here is, the attraction here is, what it allows the company to do is say to these potential investors, well, yes, you can put your money up, we'll give you the shares, but actually we can give you some tax relief up front on the shares. So you can at the moment get 30% tax relief for investments in EIS qualifying companies. In terms of the mechanics and the process, it's a submission that the company has to make to HMRC to basically set out what the company does and the purpose of raising the funds, and it's then for HMRC to give approval to say that yes, these are going to be EIS shares that you can issue. EIS also allows you to make an advance assurance claim. So what that means is there are certain businesses that may be close to the line in terms of the types of trades they're carrying out. So one of the benefits of the advance assurance mechanism is you can approach HMRC before you've raised the money and say, look, this is what we're carrying out, this is where the money is going to be spent, and you can get HMRC to agree that actually this is a qualifying EIS company. And again, in our experience, we find that a lot of potential investors require this. And what it does is as well, it's because it's the sort of first step on the road to achieving the EIS qualifying status. It allows companies to not necessarily spend the full amount on the professional fees of doing a full application and then finding out they don't qualify. So we find it's quite an attractive option for people to follow. So for the investors, you also get the 30% income tax relief up front, which I mentioned. And the other benefit is you can get capital gains tax exemption after 3 years, after holding the shares for 3 years, as well as deferral relief. So what that means is often we'll get people on the other side, so not necessarily talking about the company, but people who are looking to invest in companies, and they might have had a windfall from the sale of their own company. And if they have, they can basically defer the gain that they made, so they don't have to pay capital gains tax on the gain that they've made on the business they've sold, which defers it down the line, basically, because they're reinvesting in EIS shares. On the other side, because EIS companies tend to be in the SME sector and potentially high risk, even if the company doesn't succeed and there isn't a nice exit at the end, what the EIS provisions allow you to do is claim loss relief against your income if the investment fails. So what it does mean is that it incentivizes investors to take the risk on these types of businesses. And it does mean that their actual commercial loss is mitigated somewhat because of the 30% tax relief and being able to offset the any loss against your income. There's mechanics as to how that loss works, so it's not double dipping of a relief, but it does certainly mitigate what the loss might be. And then now moving on to employee ownership trust. So again, if we're looking at life cycle of a business, an EOT is about really an exit. So EOTs have been around since George Osborne stays as Chancellor. They're very attractive, I think, for a founders or founder wanting to exit a business. Essentially, what it allows a person to do is to exit without there necessarily being a third-party acquirer, because you're exiting to a trust, which is incorporated and now has to be UK trust. And whilst there are commercial risks, often what you get is the business is worth a certain amount. It's part of the process to value the business to get what that number is. Often the proceeds can't necessarily be paid out of the company based on its liquid assets. Often there's a gap there. So there is a financial risk, of course, when you're selling to an employee ownership trust, because what you're doing there is you're hoping and you're basing your decision on the fact that the business will essentially be able to fund the proceeds, if there are deferred proceeds, which is often the case, down the line. So you do have a sort of corporate governance angle to consider about actually who's going to be taking over running this business once you've sold your shares. An EOT does allow you to continue to have an involvement in running the business, but there are, and there's been tightened up restrictions about how involved you can be. So in certain circumstances, it's very useful, and I suppose those circumstances are where you've got a strong management team that can take it over, and are happy to take it over with in an EOT structure. And the other point as well is you can have an EOT, as I've mentioned there. You only have to sell essentially the majority of the company, so it can be as 51% of the business selling to an EOT. And so what that does mean is, if again you do have some strong management team that's going to take over running the business, what you can do is you can have the EOT running alongside an EMI. So again, those individuals, those key people, get incentivized by their own stake. So that works quite neatly and nicely. Whereas the EOT, the purpose of the EOT is that is a all staff benefit. So what that means is there's quite limited ways you can differentiate the award in EOT. Basically, the idea is that every staff member should be able to benefit from an EOT, meaning that essentially if there's a sale, some of the proceeds would be able to go to basically more junior staff, as well as the people who have been around longer. So you can differentiate between them, but it's relatively limited. So because an EOT is an all staff award and EMI is very discretionary and specific, then that's why these two can work well quite nicely together. The benefit of selling to an EOT, as I said, is from a business owner's point of view is, okay, you don't necessarily need a third party there, but also the big benefit is it's a capital gains tax-free disposal to the EOT. Again, there's rules about clawbacks, but if this is a proper sale and you're stepping back, then in general clawbacks won't bite. So it's a nice capital gains tax-free disposal. In terms of the EOT, whilst the founders made a disposal that's CGT free, the trust takes on the base cost of the shares as at the date of the disposal. It takes on the base costs from what the individual acquired the shares at, not what they sold it at. So actually what happens is the gain gets deferred into the EOT's ownership. So we do see some call for EOTs. It is definitely a valid thing for people to consider as an exit plan alongside MBOs. and obviously just a straight third-party sale. Now moving on to capital allowances, I referred to that earlier on in the presentation. It's a bit more detail here. As I mentioned before, anytime you're doing CapEx, we would always be looking at what have you spent your money on. Capital allowances and specifically AIAs are 100% first year write-off when you spend on items on this slide like plant and machinery, office equipment, vans, basically electric cars. So we find that most clients, if they've spent the money, there's £1 million allowance for the AIA. It's normally covered within that, but important to identify these items. So important that when the work is being carried out, the tax compliance work, that these items are being considered, and if they're not, they need to be brought to the attention of the people carrying out the work. So then in terms of other types of capital allowances, we've got structures and buildings allowance. That's a bit more modest type of capital allowance, 3% relief, but useful if you're constructing a commercial building. You can basically get a 3% write-off per annum for work that expenditure you were going to be incurring anyway. I think allied to what I was referring to earlier about annual investment allowance, when you're talking about fit outs, one of the things to consider is not just the structures and buildings 3%, but also your integral features. So things like electrical systems, air conditioning. You can get essentially 100% tax relief on that if you've not exhausted your 1 million annual investment allowance. And then in terms of research and development, R&D, you can get 100% capital allowance as well, when basically it's a capital item you've used that you needed to buy in order to carry out your R&D work. Outside of AIA and some of the other allowances I've just mentioned, we've now got full expensing. So normally what we recommend to clients is you claim your AIA first, exhaust that first, and then you look at your full expensing, which, as I said, there is 100% allowance as well, or 50% for special rate items, which are the integral features I've mentioned. And the reason we kind of prioritize AIA out ahead of full expensing is that when you do full expensing, if there's a disposal down the line, you generate some proceeds, and the proceeds are essentially end up being a straight tax charge, whereas with an AIA, it just reduces the balance on the pool. So that's often why we'll recommend AIA to be exhausted first. I suppose another point about AIA is a shared allowance in terms of a group sharing allowance. So if you've got a large group, you have to be conscious and cognizant of where you're claiming the allowances and making sure you're not over-claiming the £1 million amongst the group. And we've now got here a case study to bring to life some of the items I mentioned earlier. So specifically EMI scheme, we had a client that approached us and actually had a very broad open question saying, we've got these key people in the business and we want to give them a stake. They've done a really good job, and we want to really drive them to make sure that we can see an exit, a disposal in the next 5 years. So they approached us on that basis, and clearly one of the discussions we always had was on EMIs, and it really suited what the client was trying to achieve in terms of, again, it's the idea of retention. It was this promise, and actually, given the sector, it was in the tech sector, it's relatively common now to have share awards to individuals. That's one of the big attractions of working in a tech company. So often, if you're not offering that to your employees, then you're at a disadvantage to your competitors. And so how it worked was once we had discussed the various options, we talked about EMIs, and then we set about designing how it would work. In this particular case, it worked. They wanted it to be exit only because of those cash flow concerns that we're talking about there, and also because the attraction to a business like this is fast growing. So it was the promise of a very large upside and motivating people, aligning their objectives, the staff members, to the original founders to really drive this business to a sale. So what we did was, I mentioned earlier that in terms of practicalities, it's recommended to agree the valuation with HMRC. And so that's what we did. We looked at the most recent financials of the business, and we then prepared our valuation, which we discussed with the client, and made changes where necessary and updates where necessary. And then we submitted that to HMRC, and then we got the agreement from them. And then often, once we got the valuation agreement, we often partner with law firms in order to actually draw up the paperwork to implement the EMI scheme. It's now becoming a more specialist area, so we take legal assistance on that area. And again, we liaise very closely and we work with a number of solicitors, and equally we work sometimes with solicitors that our client have that deal with in generally in commercial matters. So there's a number of ways we can work. We agreed the parameters of the award. It was going to be time-based vesting and exit. And so that's what we managed to achieve. And then, so it sort of end-to-end, from memory, it was about sort of within 8 weeks. So even including the HMRC turnaround. So it's fairly swift. And obviously, by the end of it, we had some very happy, the company had some very happy employees who had seen that actually the founders really believed in what they were bringing to the business, and really decided that actually they deserve this award and can really play a massive part in the future of growing this business to make the award even more valuable. And as has been mentioned there, you get what was 10% BADR disposal exit, now 14%, and then going to 18%. As I mentioned earlier, obviously we essentially, because this is a tax-driven relief, we tend to manage the process. So in terms of, as I said, bringing a solicitor on board if we need to, if the client doesn't have anyone in mind, but also obviously sort of managing stage posts in terms of getting the valuation, getting the terms of the EMI agreed, and working with the solicitors, making sure that everything is on time and there aren't any delays, and this can be implemented as soon as possible. And again, the corporation tax is a really nice bonus that's going to be waiting for this company if and when there's a successful sale. I talked earlier about profit extraction. So this bit about family-owned businesses. So using family members' allowances, it's quite common nowadays when you've got sometimes spouse, husband and wife businesses, or some partner businesses, and you've got children, to maybe give them shares so that you can use their allowances. Now, clearly there are anti-avoidance rules about giving minors shares and paying them dividends, because they're actually, if you're to do that, as anti-avoidance legislation to actually tax the income on the parents rather than the children. However, there's still ways you can provide shares to family members, certainly adult family members, where it will provide, you don't have to worry about this, or you can certainly manage those anti-avoidance matters. And also it's quite useful, actually, again, thinking ahead about a possible exit, possible sale, useful to have the share ownership separated among as many people as possible in the family, I mean, as many people as you can trust in the family, so that you get to use people's allowances on a sale. You do have to be, again, very careful about how you do this, not just the commercial aspects, because as I mentioned, once you give shares away, then those shares are not yours, and there's issues about divorce, for example, that could mean that shares fall into hands that were not intended. So this is certainly not something that is that tax shouldn't necessarily be at the forefront. The whole commercial picture needs to be looked at. And again, there's a number of solicitors we work with. They're very good at drawing up shareholders agreements, there's even a question to say, does a trust make sense? That gives another layer of legal protection because you're not giving shares directly to the individuals. Also has some tax benefits. And we're getting a lot of queries now about the changes in BPR that were announced at the budget last year, and trusts can be one of the ways to manage that. There is currently a window between now and the 5th of April to set up a trust and achieve some of the benefits that are going to disappear from the 5th of April. So it's a good time to start thinking about business structure and succession planning, even if that might be some years away. It is worth thinking about those things now and getting those things in place now. Pension contributions, this is a very useful, very powerful tool for businesses to consider in terms of tax efficient profit extraction, because the company gets relief against its profits for employer contributions made on behalf of employees, and obviously the individual then gets their pension pot built up. There are limits to how much you can put in, and we have a very good team of IFAs who work with a number of our clients to advise on levels of contributions that can be made. And again, it shouldn't be lost that family members, they can be building up pension pots. So useful to always think about that when you're thinking about your pension contributions, because there is no age limit on age minimum, age floor on pension contributions. We do have some clients who have pensions for their children from almost from the date of birth. So always useful to consider what can be done, even if not through your business. Dividend planning, as referred to earlier, again, kind of aligns with this idea of splitting shares across family members. That's the way that you'll be able to get dividends into their hands. Again, with the proviso that these individuals are not under 18 at the time the dividends are being paid. But yes, certainly, if you have got non-income earning family members, adults, useful to try and use their 12.5 or so thousand tax-free allowances with dividends, plus the dividend allowance, which is obviously reducing as time has gone on. And then even if it's the dividend is paid such that the taxpayers, dividends are still the lowest rates of income tax. You could be paying at 8.75% at basic rates. So there's still a rationale to be paying dividends to non-earning individuals. So what should you watch out for? I mean, I've got here slides on IR35. I mean, this is obviously warrants a completely separate presentation, so I'll only mention this in passing. Again, we have a number of clients who are either contractors themselves or take on contractors. So this is an area for both sides of the fence to be aware of. So IR35 is really a piece of anti-avoidance legislation, colloquially called IR35, now called off-payroll working, designed to catch individuals, essentially one-person businesses who are working for another business, but not on the payroll. And the sort of areas that you need to look at are listed here from 1 to 9. These are the areas where, if you fall into most of these, that you've probably got an issue to say that actually you should be taxed like you're on the payroll rather than being taxed by your own company. We have had actually someone come to us recently who fell within this, so we had to sort of unwind that and declare this to HMRC. And again, a lot of the work we do is with due diligences. So I've got a very strong corporate finance team, and on the tax side, this comes up time and time again about have you considered whether you've got any IR35 issues. So it's really important to take stock and take control of this now, rather than as part of the due diligence process. So again, we're available to have a look at this if anyone has any issues or thinks they might be falling within these rules. That brings me to the end of the slides. So we've got this contact us slide. I think Kay will probably circulate this as part of, as you say, you've got the slide deck and you're going to have our contact details on there. Is that right?
That's wonderful. I will indeed. And thank you very much indeed for your time. There is no questions in the Q&A. So if anybody has any questions they'd like to post in later on, you can send them to us at hello@rpgcc.co.uk and we'll come back to you. With that being the end, Anand, that's, I guess, the end of today's session. So thank you very much for joining us. And I wish everybody a lovely afternoon.
Yes, thank you very much, everyone.
Thank you.